Hi everybody, welcome back. In this next set of videos, we're going to be moving on to a new topic, which is externalities. And so we're gonna discuss externalities and kind of how we can analyze them using supply and demand framework in economics. And then we're going to continue using this idea of externalities as we move on to the next set of videos on public goods, common resources, and things like that. So in this first video, we'll do a little introduction, talk about what this looks like in supply and demand framework, and then we'll in future videos go into a little bit more detail, look at some different policy options to handle externalities like pollution, and we'll go from there. So let's go ahead and dive in with our introduction. And so if you recall back to quite early on in earlier videos, we had some principles of economics that are related to things that we use to understand environmental economics. So Microeconomic Foundations. And the first one of those that we're going to review and understand is that markets are usually a good way to organize economic activity. Markets are usually a good way to organize economic activity. Okay, and we saw that and explained through multiple reasons that a market-based economy is going to do a much better job at allocating resources in a command or socialist type economy, because markets generally do a good job at allocating goods to the people who value the goods the most, to the firms that have the lowest costs of production, and it ends up with a very efficient outcome. But there were a couple assumptions underlying this idea. So one, we have highly competitive markets, both a lot of buyers, a lot of sellers. But then the other one is related to externalities. And so the lack of competition is a market failure. Externalities are another market failure. And so an externality, let's define that, the uncompensated impact of one person's actions on the well-being of a third party. The uncompensated impact of one person's actions on the well-being of a third party. This could also be a person's, or it could also be a firm's impact. And so most externalities that we think about are negative externalities. So you have a market interaction going on between two parties, and that market interaction is causing a third, either positive or negative impact on a totally unrelated person or entity that's unrelated to whatever the market transaction is going on. So when we have a normal market with self-interested buyers and sellers, let's see. Okay, there we go. So when we have a normal market with self-interested buyers and sellers ignoring the effect they're having on third parties, then we're going to have an inefficient market outcome. And the market is not going to do the best job at allocating resources to the benefit of the total society. So when that happens, we have another one of our economic principles that we talked about, which was that sometimes government can sometimes improve market outcomes. Governments can sometimes improve market outcomes. Okay, and that is going to be the case here with externalities. We're going to talk about some different public policies that are going to be able to improve efficiency. Some that are more with more government intervention, some with a small amount of government intervention that basically recalibrate the incentives within the market. Okay, so those are the principles that we're working with here. And now let's turn back to externalities themselves and talk about some different examples. So neighbor's barking dog, that's not so much a market transaction, but you have, a neighbor who is kind of in a way consuming the entertainment or the companionship of an animal, but that ownership of a dog is having an effect on a third party, which is you. Same thing could be for a roommate or the next apartment over playing music quite loudly and affecting you through their own consumption of music. Secondhand smoke has health risks. Someone's consumption of a cigarette will negatively impact those around them. If nothing else, from discomfort, it could even be health risks. Talking to us on a cell phone while driving makes the road less safe for others. Common example here, kind of an environmental example, would be air pollution from a factory. Right? If you've got a factory that is making energy for these houses over here, the market transaction is only this two-way interaction. So the factory creates energy, sells it to the houses for money. That's the market. But if there's another town over downwind from the factory and the pollution from the factory comes over here and they're not getting their energy from the factory, then that's a negative externality, and this air pollution is gonna cause some problems. So that's a pretty stereotypical standard example of a negative externality. A couple more I'll just add here. Light pollution. From living on a busy street, or even more so, light or noise pollution coming from a construction zone that's been put up next to your apartment. And then finally, similar to the air pollution, we can have water pollution. Running downstream from a factory. Okay, so those are all a bunch of examples of negative externalities. There are also positive externalities. For example, by a common example there, which we'll get into a little bit, or might at least discuss when we talk about public goods and common resources, would be education. So by me getting educated, by you getting educated, that's going to improve your outcomes, but a highly educated population also confers benefits to everybody in society. A standard example of that could be like, innovative research that changes our lives for the better. So somebody's engaging in research, somebody's engaging in research that's going to affect everybody in society. But everybody in society is not going to pay that person. Maybe their employer or the university is going to pay that person. But their research is going to have positive externalities on everybody. Okay, so that's an example of a positive externality. We're going to focus primarily on negative externalities. Okay, and we're going to do that by looking at supply and demand framework In the last sequence of actually a couple sequence of videos ago, we looked at welfare economics, consumer and producer surplus. And so just to recap there, remember that the supply curve shows the private costs of production. And the demand curve shows the willingness to pay, or what we can really think of as the private value. And the only difference here is that I've added the words private in front of it, because with externalities, there are going to be the private costs. Let's say the firm's costs. But there are also going to be social costs. So we'll start with this. Remember, if we have a normal market equilibrium, what's above the price below the demand curve from 0 to the equilibrium quantity, or to whatever quantity is being used, that's the consumer surplus. Below the price, above the supply curve, that's the producer surplus. And then together they make up total surplus. And so demand, we have private value, or also willingness to pay. I'll go ahead and put private. And that's our setup. So just giving that as a little bit of a recap. But now, once we add externalities into the mix, not only do we have private costs, we have social costs. And social costs are just equal to private costs plus external costs, which are arising from that negative externality. The external cost is just the value of the negative impact on bystanders. The value of the negative impact on bystanders or third parties. And so we can show that also in a supply and demand framework. If we start here and we have the private cost, and let's say that we're taking an example where gasoline, emissions from gasoline engines creates pollution, and there is some harm to society from that. There's smog, greenhouse gases that can cause health problems, and so on and so forth. So let's suppose that the value of that harm is $1 per gallon. And so what we do here is we just shift up the supply curve by $1 a gallon, and this will give us the social cost. Okay, and so we have demand, which demand is just going to stay the same. But then our private costs increase by whatever the external cost is to give us the social cost. Okay, and so from there, we can see that the socially optimal level of gasoline would actually be 20. So this is the Q socially optimal. And then 25, let's use the big dot theory of economics. So we just make the dot a little bigger. And we'll get our equilibrium quantity of 25. But the socially optimal quantity of gas is 20. Okay, and so any quantity below 20, so anywhere down here, society would be better off by increasing gas consumption. Any quantity over there is going to make society better off by decreasing gas consumption. Okay, and we have the market equilibrium is greater than the social optimum, and the social cost is greater than the social benefit, when we're in the market equilibrium. So what do we do about this? We're going to talk about a couple examples, but one simple solution is to tax sellers or firms $1 per gallon. And if we did that, this would shift up the supply curve by $1 at all quantities. And so this is the initial private cost. This is our social, hold on. This is our social cost. But if we just tax the sellers and add to their costs, then the sellers' costs are increasing, and the sellers' costs become the social cost. Social cost number 1 from social cost number 0. And when we do that, we're doing what's called internalizing the externality, and we're just making the social costs, we're making the private costs become the social costs through taxation. So all the firms have a larger cost that's going to shift their supply curve. So now this is S1 instead of S0. And this socially optimal quantity becomes the new market equilibrium. So it's going to be 20 instead of what was previously 25. And so that's what's called internalizing the externality. And so we're altering the incentives of firms or individuals so that they take into account those negative externalities into their own decision-making process. And that's what we're doing here with a tax on gas. And when that happens, we have a couple things going on. One, private costs become equal. Private costs become equal to social costs, and the market equilibrium becomes equal to the social optimum. Okay, and so essentially what we do with a negative externality, the market equilibrium, the market quantity will be larger than socially desirable. So you internalize the externality with a tax. This is called a corrective tax. And if it was the opposite situation in a positive externality, instead of taxing what we would not want, we would subsidize what we do want. So that would be called a corrective. That would be called a corrective subsidy. Okay. And so that's the general idea. That's where we're going to start. And then in our next video, we're going to start looking at some more public policies, command and control policies versus market-based policies, and take a look at what we're working with there. So thanks for watching, and I will see you in the next video.